Good morning and welcome to What's New This Week with David Luna. Here's a quick message from our camp president, Ms. Audrey Voiceno.
Can't hear it.
Oh, it's delayed.
No, it's not delayed. Bear with the technical problems.
All right, I apologize for the technical problems. All right, let's just have an intro from Audrey. Ms. Audrey, are you there?
I am so here. Geez, what a relief. That was excruciating to watch and not listen to. Okay, so welcome everybody. We're so happy you're joining us today. A big thank you to Dave Luna, who is here for our weekly get together, and Kevin Casey, our president-elect for camp. And thank you as always to Megan Jackson, with whom this would not ever happen, without whom this wouldn't happen. Upcoming events, we have an NMLS class on Friday with Mr. Dave Luna that is being sponsored by camp. And when you go to the link and register, go to the drop down and choose your chapter. And each chapter, if you choose the chapter that you belong to, or will belong to once you joined camp, that chapter will get credit for this class on Friday. So please make sure you do that. And at the chapter level, let's make sure we're promoting this event. Next Tuesday, Dave and I are going to have a special guest, which we will announce momentarily. Okay, not momentarily, not today, maybe tomorrow. We're just nailing down the details of that. But next Tuesday at 11, mark your calendars. We will be here. And we are doing a camp cocktail party. Or if you don't drink cocktails, you can drink something else. Dave Luna, what would you be drinking at this party? Milk, orange juice, Gatorade?
Apple juice, Sprite, 7-Up.
Apple juice. Perfect. You can drink whatever you want, or just, eat to your heart's content, whatever does it for you. So next Thursday, May 21st at 5:30, we'll be doing that. Look for the invite on that. Good Lord, David, it looks like you're on a roller coaster. Then on May 28th, we are having another NMLS class, this time with our president-elect, Kevin Casey. And he is going to be presenting for us. And again, the same thing where you go to register, do the drop down, pick your chapter, do it that way. If you're not a camp member, please, what?
Register on the front page of the camp website, the camp site.
Right. Or look for the emails that are being sent too, either way. And also, all right, I lost track of where I was. Membership. If you are not a camp member, please be a camp member. Please support us. We're a bunch of volunteers here fighting the good fight, and your membership is very, very important in our organization. And if you haven't renewed your camp membership, please do so. Right now, we're doing these events for everybody, but eventually we're going to transition to having more members-only events. But at the very least, we need your support. So without further ado, Dave Luna, please share with us what is going on out there.
Before we started recording with everybody, we were just having a conversation a little bit offline that there was really no negative news that happened this week. So for our mid-May update, I think I better start off with some negative stuff, but then I think I'm gonna make sure everybody understands it isn't really that bad. I understand unemployment is at a staggering 33.5 million people, which is very, very unfortunate. And it represents an unemployment rate of 14.7%, which is absolutely astronomical. We started by saying that there wasn't any negative news, and I think you could look at that as negative news, but I think I can turn that as we move further on in this update. In the next 6 months, you should see brand new FICO scoring models. So I think, and I'm not sure, I'm guessing FICO 9 has been out for roughly about 6 years or so. I'm totally guessing. But in the next 6 months, you should see 2 new FICO products, FICO 10 and FICO 10T. So before you ask, I wanted to answer some of your questions of what the differences are besides, the newest version. If you have borrowers that have scores on the lower end, say in the 600 range or less, that are not good payers, which is probably why they have a 600 credit score or less, then the new FICO 10 will actually be harder on them, meaning their scores will drop. So those with good pay history should see their scores actually increase with both versions of FICO. Now, the difference between FICO 10 and FICO 10T is the T is for trended data, or in other words, they're looking at the last 24 months of how borrowers are paying their debts. And let's dovetail that with what's going on with deferred, forbearance, and things like that. So credit reports are showing the accounts as current, but we also know in the notes section, those accounts are flagged as either deferred, forbearance, or affected by natural disaster, which is what this pandemic is. So those are flagging accounts to say, okay, this is probably a deferral or a forbearance type of a situation. And then HUD, their Office of Inspector General, is actually disappointed, if I could candy coat it, mad, not happy with some servicers of FHA loans, because those servicers are giving information about forbearance, according to the report. This is not my words, that information about forbearance was incomplete, inconsistent, dated, and unclear. So that report only came out, what, 4 days ago. From CNBC on May 12th, 2 days ago, it was reported, quote, in a rush to help consumers who've been financially impacted by the coronavirus pandemic, the government authorized a massive mortgage bailout under the CARES Act. Nothing new for us. Some borrowers' inquiries were misunderstood, and some servicers swamped with hundreds of thousands of calls just automatically put borrowers in a forbearance program. And they didn't ask to go into forbearance. They kept their payments up on time as agreed, but now that they're trying to take advantage of these low interest rates, they can't refinance because they've got a forbearance, even though they never formally requested one. They didn't go into one. They were just asking questions. And so we're starting to see some of the mess that was going on in everybody's rush to handle that volume of phone calls. And I'm going to assume that maybe these people were not 100% trained in what they should have been doing. Okay, so Fannie Mae updated the impact of COVID-19 on their newest letter, LL 2020-3, and that extended the their temporary policies through June 30th, because some things were going to be ending. So Fannie Mae, the lender letter dated 5 had some FAQs, and for everybody, let's just take a half a second and understand some of these FAQs. So they were extending this temporary policies from May 5th to June 30th. Unemployment benefits, borrowers are asking, can I use those as qualifying income? The answer is obviously no. The only time we can use unemployment benefits if it's associated with seasonal employment. Furloughed borrowers, again, Fannie is clarifying that income of a furloughed borrower is not eligible under the temporary leave income policy. Age of documentations went from 4 months to 2 months because obviously they want to have everything current. Verification of self-employed borrowers, they're requiring confirmation that the borrower's business is still open and operating within 10 days of the note date. They were also providing an expansion of the remote online notarization, and they wanted lenders to do some QC re-verifications, either verbally or electronically, after consummation, as well as flexibility with appraisals. Let's talk about the Cfpb. I'm going to say something that you're not going to believe, but let me explain. The Cfpb actually asked the FCC to allow robocalls. I will let that sink in. The Cfpb actually is asking from the FCC permission to allow robocalls. Now, as if you're sitting there thinking, what? Let me explain. Quote, from the director, to allow financial institutions to make certain automated calls to alert their customers to certain relief options related to COVID-19 pandemic without violating the Telephone Consumer Protection Act law. Director Kathy Kraninger said, quote, despite our best efforts, we know we've not reached all consumers who need and would benefit from available assistance. Allowing financial institutions to make automated calls is one more way to maximize the outreach to ensure consumers receive important and timely information, close quote. The Cfpb also put out their guidelines regarding responsibilities of financial firms during the pandemic, dated May 13th. If you look at your calendars, that was just yesterday. So the Cfpb is also putting out things, responsibilities of what we're supposed to meet. Please check out their website. MBA, I think this is kind of good news, reported that forbearance requests fell for the third consecutive week, and that calls about forbearance accounted for the lowest percentage of total calls since the survey started at the beginning of March. Black Knight is also saying the same thing that MBA is. It's talking about a slowdown of forbearance requests. Now, that doesn't mean forbearance has stopped. It's just slowed down, indicating that some positive news, such as maybe we're hitting, as high as we're going to get, we're going to really need to see what happens after tomorrow. See, borrowers have those 15 days, right, before they show up as late. I think next Tuesday when we visit with you again, we'll have a better idea of what May numbers are like. Another sign that things are starting to loosen up, IRS offices, good or bad, responsible for providing our 4506Ts are now open. In fact, if we're talking about opening, 30 states have allowed businesses to open or have announced plans to do so in May. Tech companies, however, are bucking the trend, and seeing that we're Californians, we have a lot of tech in our state. Tech companies are doing the opposite, telling their employees they can continue to work from home, or WFH. Companies like Google, Facebook, Microsoft, LinkedIn, Zillow, as well as others, they're saying, hey, don't even come back to work until 2021. Real estate purchases have taken a hit in California, as we all know, as reported by CAR. However, fundamentals, this was a previous webinar where you guys asked questions. Dave, what do you think is going to happen with real estate? I think pent-up demand is still there. I think we still have a nagging housing shortage. And I think with lowest rates ever on record, I think we're still going to have a very good buying season. So as soon as we can all start freely moving around, I think you're going to see purchases come back. As I said before, we will have a strong spring buying season. It's just temporarily been moved from spring to summer. Okay. The next stimulus bill is on the Hill. They're looking at $3 trillion more dollars for states and local governments, education, public safety, according to Wall Street Journal. The Democrats are calling it the HEROES Act, which would provide $1 trillion for state and local governments, $200 billion for essential worker hazard pay, $75 billion for COVID-19 testing, tracing, isolation efforts, and a new round of direct payments to Americans of up to $6,000 per household. So again, there are still many, many folks that still need help, including schools. So think about schools for just a second. Now, Dr. Eisenberg, who's a bow tie economist, this is due to endowments and endowment income being down, sports revenue being non-existent, and refunds being due to COVID-19 campus closures. So add in tax revenue declines, forcing university tuition up, thus making college more unaffordable, and fall 2020 classes likely to be online, pushing enrollments even further. So will this be the last stimulus if Americans are now allowed to go back to work and the economy is finally open? I don't know. We're going to need to see. The vote in the House is scheduled to happen tomorrow. Who knows what happens when it hits the Senate side, because the Senate leadership has said they won't even consider another stimulus package until at least June. President Trump jumped in and said it's DOA, quote, dead on arrival. Fed Chairman Jerome Powell said yesterday, he warned that the threat of a prolonged recession, we are in a recession, folks, right now, resulting from the viral outbreak, he urged Congress and the White House to act further to prevent long-lasting economic damage. Additional rescue aid from government spending or tax policies, though costly, would be, his quote, worth it if it helps avoid long-term economic damage and leaves us with a stronger recovery, close quote. All right, Brian Montgomery, yay, was finally confirmed Tuesday by the Senate in a nonpartisan vote of 61 to 29 to be Deputy Secretary. Now, if you don't know what that means, that's the #2 position at HUD, serving under HUD Secretary Ben Carson. There was a new lender letter, LL 2020-7 and Bulletin 2020-15, both of them dated yesterday from Fannie and Freddie. And in response to the COVID-19 pandemic and servicer feedback, they're introducing the payment deferral. It's a new workout option specifically designed to help borrowers impacted by a hardship related to COVID-19 return their mortgage to a current status after they may have been missing payments for up to a year. This solution is for borrowers who have completed a COVID-19 related forbearance and who have a confirmed but resolved COVID-19 financial hardship. Now, this thing is like 12 pages long. So ladies and gentlemen, we don't have time to go through the whole document, but we do have some things that I think are important. And I think I've limited it to maybe only 3 bullets. 1, a solution that's simple to explain to borrowers. Please, this is what we do day in and day out. They don't do what we do. And so it's got to be understandable to them as to the amount of their delinquency, moving to a non-interest-bearing balance, due and payable at the maturity of the loan or payoff or refi, whatever happens first. Number 2, no trial period, like we used to have with loan modifications. And number 3, an automated process for evaluation and deciding case submission. So if you want to read the whole letter, jump to Fannie and Freddie's website where, again, it's brand new information. Now to wrap up my portion, good news from CNBC. Mortgage applications to purchase a home rose for the 3rd straight week, up 7% compared with last week. Refi applications are up 200% over a year ago, with rates over a full percentage point. When they were a full percentage point higher a year ago, they're a full percentage point down. The spike in refi income is very, very good to our lenders. It's been absolutely amazing, fantastic for 2 reasons. 1, remember, as borrowers aren't making their payments, lenders now have to, forward those payments. But if those lenders are doing all of this business and purchase and refi, they are getting cash flow. Getting cash flow allows them the money to advance those payments, number 1. Number 2, it's paying off old loans, at a higher interest rate with new loans at a lower interest rate, which is also providing companies cash flow. So that's also good. Now, remember I started off saying we have 30+ million people unemployed, and that's a very, very sad number. But let's drill down just a little bit further, and then I think I'm pretty much done. Of the millions that are unemployed, approximately 18 million are classified as temporary layoffs, indicating those workers are expecting to return to work. So that's 88% of the recently unemployed. So most of the recent layoffs are planning and expecting to be rehired. So I'm seeing all types of employers looking to hire. So even though the unemployment numbers look absolutely awful, it still means 80+% of Americans are still working today right now. And as I've been telling you that rates were going to continue to fall, I saw a major lender Tuesday, 2 days ago, drop their 30-year fixed to 2.5% for purchases and rate and term refi. So I think Audrey wants to say something about that, so I'm going to leave it up to Audrey. Bloomberg 2 days ago, traditional 30-year home loans with rates below 3% are inching closer as the Federal Reserve works to stimulate the U.S. economy. The Federal Reserve Bank of New York bought contracts for $240 million of mortgage bonds with a coupon of 2% on Monday. The first time it's ever purchased mortgage securities promising to pay so little interest, according to a Fed spokesperson. The move suggests lenders could easily sell mortgage loans at rates below 3% to Wall Street investors, a key step in pushing down borrowing costs that are already near historic lows. And the Fed isn't finished with the low coupon securities. The central bank has said it will buy more this week as part of a $20 billion in planned securities purchases, virtually guaranteeing a buyer for recent 30-year mortgages with rates as low as 2.5%. I've told you guys for, years that we would be below 3%. You are starting to see that more regularly. And I'm not just talking, government, I'm talking all loans, govies, conventionals. We will see rates below 3% in the not too distant future. I don't know exactly whether it'll be 2020 or whether it'll be more like spring 2021, but rates are going to be amazing. You should, guys, speak up. I think you guys should be seeing rates consistent, and they never go in a straight line. Up and down and up and down and up and down, but it's trending toward lower interest rates. Is that what you guys are seeing right now? Yes or no? Yes, no, yes.
Yes. Yes.
All right. So Audrey, that's what I had prepared so far. Guys, ton of info, but I think most of it's really, really good info. Good news.
As always, make sure that you put your questions through the chat bar. We're happy to talk about whatever you want to talk about. Okay, so about 5 people said yes, they are seeing that the rates are edging lower. And it looks like you're about to eat your camera, David.
Well, I'm trying to read Jose Valencia and Jerry Godfrey and these other folks. I'm doing this on Facebook Live as well, and so I've got
gotcha.
I've got two cameras going at the same time, and sometimes I've got to lean forward, to kind of see what the heck is going on. Yes,
you should see it from our perspective. It's pretty awesome.
Yeah, Jerry, that is Torrey Pines behind me. Go ahead.
You gotta do it like Barry Habib does, Dave. Barry always leans into the camera when he wants to say something really important. It's like he's talking.
I think I use my hands a lot when I do that,
And it makes it look like he's talking directly to you.
So anyway.
So I was the one we were talking about before the show is how this week seemed to be the very first week where we didn't get any bad news. Like nothing, didn't lose any lenders. Last week we were losing HELOCs. We didn't lose any HELOCs this week. Lenders didn't seem to tighten up.
We didn't have any to lose.
Yeah, we didn't have much to lose. But we did start seeing rates going down. My company's opened up some new lenders to us so that we've got even more expanded stuff. So things seem to have turned the tide. I don't know if that's true, knock on wood, but I think we're doing better.
We've turned the corner, definitely. We really have.
Yeah, I agree. And that's why we're finally in a position where I feel like we can put on a non-QM panel and you would have time to close your loan that you submit before, without the lender going out of business, which was my concern for the first 30 to 45 days. So there's a couple things that are going on at the state and national level that I wanted to mention. And one of them is that NAM is very actively interfacing with our congressional leaders and FHFA, et cetera, to make sure that our issues are being heard. And so they just sent a letter on May 12th to the Senate Banking Committee and FHFA, making the case once again for the forbearance issue. We did a call to action at NAM, and CAMP pushed it out too. We have had over 25,000 responses so far, which is national, and in the scheme of things, based on the number of mortgage people there are, it should have been more, but it's growing. That means everyone is starting to engage, which is so critically important. So I would just ask everyone, when you see these calls to action go out, make sure that you are responding, and you can send them to your clients and your family and whomever you can get to respond to them. You don't need to be a CAMP member or a NAM member to answer a call to action. These are issues that are impacting our clients on the street level, and so everyone has some skin in the game on this thing. So they're asking that consumers be required to sign something saying that they understand what they're agreeing to before they're put into forbearance, because we're hearing a lot of stories about certain lenders that are putting people into forbearance merely because they asked a question about it. They're not asking to be in forbearance. And so that's causing some issues.
They're just asking questions. What are my options? They didn't actually ask to be put into a forbearance program.
Right. And this isn't just one instance that we're hearing. This is so many people this has happened to, and multiple lenders. So, the sense is, lenders want to get the 4-month period started, of payments that they're responsible for, and get it over with so that they know how much they're on the hook for. And but it's causing a problem for our borrowers. And so NAM is all over that. They are, the flip side to that is there's a lot of reasons that lenders don't want people to be able to refinance right out of forbearance, because they don't want all that early payoff. So, right. We've got some conflicting agendas here that are going to be interesting to play out. But I think for most of us, we can agree that, the sooner someone can get out of forbearance or not be in forbearance and be able to refi, the better, right?
And here we are thinking that all the lenders are going to be saying the same thing. And remember what I told you guys, that the HUD's Office of Inspector General, as they're auditing servicers, they're saying that the servicers are not saying the same thing. So one servicer is saying this, and one servicer is saying this, and I have to come up with a lump sum. Oh, wait a minute, I don't have to come up with a lump sum. It's just all over the board. So it's now hit the levels, of Washington, D.C. folks that said, and remember, I told you what their quote was: inconsistent, unclear, incomplete. I'm going to add my own wrong information to borrowers that are really trying to figure out, what do I do with this loan that I've got? So it's right. not just lender by lender. It's all across the country with many servicers. So we're going to be dealing
in the servicer's defense, when this all rolled out, there wasn't a lot of clarity given to them. So they were in a position where all of a sudden their phones are ringing off the hook. They have to bring in people who are new, who probably don't, most of them don't even have a mortgage. And all of a sudden they're supposed to answer questions that nobody has the answers to. So it's just been a tough situation. So it's working itself out as we speak. Another thing that's happening right now, because this has been a big issue in California, is the fact that, when renters aren't paying their rent, how do landlords make their payment? And we have yet to hear a city or state say, don't worry about making your property taxes, but by the way, let your borrowers, your renters not pay, right?
Yeah, there is all on the landlord, that the landlord is supposed to absorb it or something. And some landlords have the means to do that, but some families, may not have the ability to make a payment if, somebody is renting their place. And so I think it needs to be a little bit more fair, instead of, all towards, just renters. But that's just my opinion. Sorry.
Right. So on Tuesday in California, the Senate leaders rolled out 2 ideas for helping renters and landlords, which that's a nice little change of pace, right? Yeah. So it would allow landlords to receive tax credits for rent payments missed by their tenants in exchange for promising to halt evictions. The tenants would be able to repay the state over 10 years for missed rent under the voluntary program. So obviously not ideal, but it's a step in the right direction. So of course, the tenant rights people do not think it's enough, and the apartment association is saying they're not quite endorsing it, but it's a step in the right direction. So the idea is they would take these tax credits and rent replace and do they would run from 2024 to 2033, which right now seems like an eternity. That seems like a long time to have to wait. But there's something about the landlords being able to sell the state credits for immediate income. So we'll see how this all plays out and what it ends up looking like. But here's the good part. The tenants would have to prove that they're impacted by the pandemic, and rent forgiveness would only be granted to the neediest cases, which that's a nice change, because again, up until now, they haven't had to prove that they have any sort of hardship at all. And that's caused all sorts of problems on many different levels, right?
Like the idea.
So
Really like the idea.
Hey, at least someone is finally thinking about the landlords, and that's a refreshing step in the right direction.
When it's a win-lose situation, that's bad. But when it's a win-win situation, it may not be perfect, but I think it's at least trying to be fair, So
Right.
landlord,
Right.
here's your tax credit. You didn't have the income, but you don't have the tax liability as well. Renter, you didn't have to make your rent payment then. However, you are going to have to pay the piper at some point. So I think it's trying to be fair. I agree with you.
Right. It's something that's a step in the right direction. I mean, everyone's muddling through this and trying to figure it out. So good for them. So just a little update that the HEROES Act that you had mentioned previously also has something in it about the PPP. And what it would do is it would do an extension so that people don't have to spend that PPP money in 8 weeks. They would have until the end of the year. And that could help some people.
That HEROES is that stimulus bill that is on the House side right now that they're trying to get voted on by tomorrow. So again, let's just see what happens. I think there's going to be a whole lot of posturing between now and the weekend, definitely the beginning of next week. And I think we're just going to have to see. So even though the Senate side says we're not even going to consider anything until June, ladies and gentlemen, that's only 2 weeks away. So, I mean,
right.
$3 trillion. Audrey, you and I had a conversation offline here a couple of days ago where you were asking me what did I think was going to happen with not interest rate, it's not unemployment, it's Audrey, help me here.
We've had so many conversations, David. Which one? All right. Well, while you think of inflation, yes, inflation, yes.
And again, if this additional $3 goes into the mix, guys, we are not really needing to worry about inflation for a while. Yes, you can pick one or two, maybe three things that could affect inflation, to make it go up. But as a whole, yeah, I don't think so. I just really, really, really don't think so. So we've got so much debt. It's going to be a long time, in my opinion, before I think we see any kind of inflationary worries. So I think we're going to be fine. I really do think we're going to be fine. And again, I think we're going to be fine for a long time. Sorry, Audrey.
No problem. Just one last note on the PPP. There's $120 billion left and about $1 billion of people who have been approved who are not taking the money. So there is money there. So make sure that you continue to spread the word with your clients, friends, and family that there is money for them, hopefully, if they need it.
With strings, because last week I think we said you have to use it for salaries and you have to, it's targeted.
Right.
That you have to do certain things with it. You can't just be personally enriched by it. So if it's money for hiring new people, if it's money for paying for, salaries, and I think there was even a percent to it, like 75% of whatever the money you get has, it's earmarked for certain things. So if you follow the rules, it's actually forgiven, meaning you don't have to pay the money back. So I want everybody to think about that for just a second. Let's say you get $250,000 that you do not have to pay back. So the PPP is pretty darn cool if you qualify for it. And then there's going to be auditing to make sure that, people don't get money that they think they don't have to pay back just because they're trying to be, I don't know, sneaky or underhanded. So there are rules that you have to follow. But if you follow those rules and you don't have to pay back $250,000, that's just like amazing. It's free money. Well, I guess
and again,
free, the taxpayers are going to pay it over time, but
nothing's free, David. Don't say that.
Nothing is ever. You're right. Nothing. Nothing.
Again, just a reminder that they did make sure that they had earmarked a certain percentage of this money. They really wanted the small business guys to get it this time. They're going to audit anyone with loans over $2 million. And there are the smaller banks were also given a certain amount of money to lend. So anyway, so PPP is up, viable. Make sure that you're spreading the word. So we're getting some questions on credit, and just as a reminder, we are going to announce, we have it lined up. I just need to schedule it, a credit webinar, so that we can go through all the credit questions with really, highly qualified credit people who are really in the trenches. So that'll be coming up in the next week or two. So look for that. But they're asking, are servicers reporting any 30-day lates right now? Are you seeing that, David, or hearing about that?
Unless the person really was 30 days late. So if you go back to that announcement that I told you by Fannie and Freddie, what was it? I think it came out today. If the person was late before they went to a COVID-19, yeah, they're showing as 30 days late. The federal law, the CARES Act, tells the credit bureaus, tells the servicers, you cannot report them as late. But again, it does, in the note section is where, deferred, forbearance, affected by natural disaster, those notes are there. But if they were late before, they're still late, even though they're on deferment now.
Right. So somebody had said, won't the forbearance per Fannie and Freddie not allow the borrower to refinance or purchase for 12 months from the last date reported? And that is correct. The question is, will they change that rule? And in our conversation the other day with, the jury's out. They're changing things all the time. So maybe, but not right now, right?
Maybe, but not right now. That's a good way of putting it.
Yeah. Yep. So again, they're asking for updates on non-QM loans. And again, we have that all ready to go too, and I'm working on scheduling that.
Have you made an Audrey on that? Because I know you've been working on it. You know some of the people that you're talking to.
I do. I have, the panel is ready to go, and after my conversation with you this morning, I'm going to get on the phone with them today and nail down the date and time. So look for that, because we're going to do the idea is we're going to walk through what happened with non-QM, what happened, what is happening now, and what does the future look like. That's what the idea is. It won't be a deep dive into exact programs necessarily. We're going to have 3 different lenders represented that will give us some overview of non-QM as it is today and what we should look for in the future. So that's coming.
Look forward to
that. Do you have
that.
anything you want to add to that, David?
No. Audrey and I have been working on this for weeks. I would say probably a month.
Yeah. As soon as it went away, I started really paying attention.
Some of these people could not say anything about non-QM because of whatever corporate reasons, whatever timing reasons, whatever reasons. And now it seems like that they are now allowed to say more. And so we're asking them, and they're being very gracious, saying, sure, we'll talk about it. So that guys, that's one that you really do want to tune in and listen to about what's going on with non-QM.
Yeah. And I've heard it likened to, it's like non-QM 3 years ago. So we'll see if that's how it ends up looking. We're already seeing them rolling them out, right? So any news on or updates on the easing up of pricing on high balance? And this is my favorite topic that I can't get anyone else excited about, the de minimis. So let's talk about high balance pricing, David.
No, you're going to do it, because like I said, less than 45 minutes ago, Audrey and I were having a phone conversation before the thing started about this exact topic. And I said to you 45 minutes ago, okay, you handle that one. So Audrey,
so here's
what news do you have for us?
I do not claim to be an expert in this. This has just recently hit my radar, and I'm learning about it. But I'm very interested in it because it seems like it's something that should change. So there's a rule that of somebody's Fannie portfolio that they can only sell, that 90% of it has to be baby conforming or whatever you call them. And then only 10% can be the high balance. And if it goes over that ratio, then there is a big hit to the high balance pricing. So when you're on a coast or in any area that we have high balance areas, it's an issue because for a lot of us, high balance is much larger percentage of what we're doing.
Bay
And
Area,
so,
anything in, like Southern California, LA down to San Diego. I mean, you're exactly right. You are exactly right.
right. So what I think is interesting, and I'm always feel like I'm the one that's stirring the pot. I get a whole lot of blank stares and people going, well, you can't change that. You can't do anything. And my feeling is, why aren't we at least talking about it? Why can't we change it? Somebody came up with that ratio. Why can't we change that ratio? What if it was 85-15? Like, what impact would that have on our pricing? Why don't we have the conversation? So the answer is, I'm starting to see the high balance pricing get a little bit more in line. And my understanding as to why it was so skewed is there was no appetite for that product. They couldn't sell the loans that they were closing. Nobody wanted to buy that servicing.
That's exactly.
So that's why so that is why the pricing was so
ridiculous.
I really wanted to say, thank you. That's such a nicer word than was in my head. So the pricing was terrible. It is getting better because the appetite for these loans is coming back, right? And so it'll just be evolving over time, just like jumbo, right, David?
Yes.
Okay.
You're going to see things much different mid-summer than you're even seeing right now mid-May. So just sit tight for the next 2-3 months and things will get better. I mean, loosen up the economies, get the shelter, stay-at-home orders out, let people actually go back to work. You're going to see unemployment come down. Look at how the stock market has just been cruising. So this, ladies and gentlemen, this is bad. I never said it was okay. This is bad, but it is temporary. And what I mean by temporary is probably 5-10 years from now, kind of like that, great recession, it's going to be way, way, way behind us. Not that I think it's going to take 5 or 10 years. We really, really won't get out of this until we find a cure, until we find a vaccine, until we find something for COVID. So in the fall, winter, you might see a little bit of resurgence of some of these negative things going on. But then again, as temperatures warm up next spring, next summer, again, most of this derogatory stuff will be behind us. So nothing ever moves in a straight line. It always moves in cycles, right? So like you never lock a loan, on a Friday or something because, markets aren't usually very good on Fridays or Mondays. You wait till a Wednesday. Well, just like interest rates go through cycles, this thing is also going to go through cycles. There will be good times and there'll be bad times. And that's just the way it is until they find a vaccine or a cure.
I don't know the answer to this. Do you know what the latest data is on churning and what percentage of loans are being paid off before the 6 months?
I do not.
Yeah, I don't either. And you know what? We'll check it out. We'll see if we can figure that out by next Tuesday. How about that? Okay. And so they're asking, and again, this may be a question we can answer during the credit webinar. If a borrower requested to be placed in forbearance but has not missed a mortgage payment, which a large percentage of the people who were in forbearance actually made their payments, right, and they asked to cancel his forbearance, will he have problems refinancing if his credit note's affected by natural disaster, et cetera?
You can save that for the credit, but I'll make a stab at it. If they never meant to be in forbearance, if they never missed a payment, if they always made their payments, as they should have, then I think you can correct that entry in the credit bureaus. It's going to be a little bit of a process, but the answer is, yeah, I think you can fix it. Let's wait till the super smart people show up and ask them the same question. But I really, really think if there's ever been an error on somebody's credit, and it really is an error, can we fix it? And the answer is yes.
Right. Well, and it's happening right now because we're hearing about people having issues because DU is catching it. Right. So DU will kick them and all of a sudden they're in trouble. And I just talked to a broker this morning who had somebody who they were literally at the end of their URL and boom, the guy's like, oh, well, I already am in forbearance. And he's like, well, you're done. So it's an issue. So how does all this new government debt affect us going into the future? Higher income taxes? How about giving people $600 a week extra for unemployment for 9 months, David? How about that? How does that impact things?
Yeah, so I mean, there's nothing that's free. I think Audrey corrected me on that one. There is nothing that's free. We are all going to have to pay back this money, and that's going to be in the form of our taxes. So will there be tax cuts? Depends on what happens in November. Meaning, I mean, somebody somehow is going to have to pay for all of these programs, and look in the mirror, it's going to be us. And so are there going to be higher taxes? I kind of think yes. If man, I think I've already said it. If it depends on what happens in November, but if one particular party goes in and another particular party doesn't, then there's always going to be tax consequences.
Well, in California, which started the year with a $6 billion bonus, or they had an extra $6 billion. I can't think of the word for reasons I can't explain. Now they're expecting a $54 billion deficit. So, yeah, there are going to be some issues. I would think we're going to have higher taxes.
Yep. What does it look like, and what are your write-offs, and what does it mean? That still needs to be resolved. So it'll be interesting. This year, 2020, is going to be a very, very interesting year for not just our industry, many industries, and not just, you know, interest rates, but taxes as well. Part of it is how much money do you make, and the other part of it is how much money do you keep. So
That's right.
if you have to pay it in taxes, well, then you didn't really make that much.
Exactly. So we are at the end of our questions. And so I think that we can just say thank you to everyone, remind them to look for our updates. We have things posting on social media and emails going out all the time. Plus we post everything that we're doing on the state website. So www.thecampsite.org. And let us know if you have any questions, and we'll look forward to seeing you next week. Thank you, David, so much for everything you're doing for all of us. And thank you to Kevin and Megan Jackson, and have a wonderful rest of your week.
Right, see everybody later. Thank you.
Thank you. Bye-bye.